Good morning, everybody. Welcome to our standard webinar this morning. My name is Alan Errett. I have the pleasure of being your host this morning, Head up Retail Distribution at STANLIB, and it's great to have all of you join us this morning. Just before I kick off, I just want to sincerely apologize for the confusion in terms of the start times. I sincerely apologize for the error on some of your invites, which was the start time for 2 o'clock today. And I do appreciate, and from a team perspective, we do appreciate all of you who have accommodated the correct time at 11 o'clock, but I do sincerely apologize on behalf of the business, and we'll ensure that that doesn't happen again going forward. But thanks very much for joining us. We do appreciate it. I hope you're enjoying all these webinars. This is our next one of our webinar series, which we've been running over the last few months, and we'll continue to over the upcoming months. Please send us feedback to myself or the team, any suggestions you have in terms of kind of changes or suggestions, if you're happy or unhappy with content, etc. Always important to get feedback so that we can obviously, look to ensure that these are relevant, topical, and applicable in terms of what you require from us as an asset management business. So if I bring it to today's presentation, I have the pleasure of being joined by our Columbia Threadneedle team, our team responsible for managing our Global Balanced Fund, our STANLIB Global Balanced Fund, a fund that many of you support in terms of investments for your clients. We appreciate that support. We've seen significantly strong flows into our offshore propositions, and that's continued in the first quarter of this year. So we do appreciate the ongoing support. So to introduce the team, we've got Lyle, who's Head of Managed Funds at Columbia Threadneedle Investments. Many of you know Alex very well. He's been on roadshows and client presentations before. We're also joined by Adrian Hilton, who also forms part of the Columbia Threadneedle multi-asset team. Adrian's Head of Interest Rates and Currencies in that team. And then we're joined by Felicity as well, who's also part of the kind of Columbia Threadneedle multi-asset team, Client Relationship Manager, and she's joined us as well today. So it's great to welcome the three of you this morning to the webinar. From a kind of format perspective, we've decided to change things up a bit. So we're not going to be doing a formal presentation with a slide pack. We will be distributing a slide pack after the presentation or discussion today. But what we're going to do is we're going to have Felicity kind of facilitate a discussion with Alex and Adrian, where Felicity is going to pose various questions to Alex and Adrian, looking at kind of growth stocks. Do we think that the run we've seen is sustainable? What are the views from the Columbia Threadneedle team in terms of the global economic recovery? Do we think that's sustainable? Views on global fixed interest, fixed income, risks to global inflation. And then importantly, how Alex and team and Adrian and team are then applying those views into our global balanced proposition. And also importantly, a question that will be posed, I know we chatted about it yesterday, is the kind of shift or cyclical shift to value stocks from an equity perspective. Obviously, our Columbia Threadneedle partners is quality growth equity managers, so it'll be interesting to hear Alex and Adrian's views on the current kind of value cycle. And how that's going to potentially play out in terms of the portfolios. Please, can you send questions through as well? So what I'll be doing is I'll be watching and facilitating the normal Q&A. So Felicity will run the session now for probably around about 40 minutes. And if there are any specific questions that you want to pose that don't come through in the discussion, or you want to kind of have more discussion on some of the questions, please pose them through the Q&A functionality. The chat functionality is off, and then I'll come back a little bit later to facilitate that Q&A discussion. From a bit of housekeeping perspective, for those looking for CBD points, we know the end of May deadline is looming. So please stay on the call for the full period till midday. We are aiming to be finished by 12 o'clock today. And then I'll come back at the end of the discussion. So hope you enjoy the discussion. I'd like to hand over to Felicity, Alex, and Adrian. And thanks again for joining us. Appreciate it.
Thank you very much, Alan, and we're delighted to have the chance to speak to so many of you through this morning's webinar. And hopefully with both Alex and Adrian joining me today, Alex more from a multi-asset perspective and Adrian bringing the global fixed income view, hopefully we'll be able to answer any questions you might have on how we at Columbia Threadneedle see the world evolving, and of course how we're positioning portfolios accordingly. Now, we are, of course, a little over a year from the time when the coronavirus pandemic stopped becoming something that was happening somewhere else and instead became a pretty startling reality for all of us. And an enormous amount has happened since. We were only a year ago in a period of hugely profound economic uncertainty as governments essentially shut down economies to try and control the spread of the virus. And the financial market response was astonishing. We experienced a collapse in liquidity, which all but dried up in corporate bond markets. Equities plummeted 30% in places, and volatility spiked higher everywhere. Now, policymakers certainly didn't have the power to cure the virus, nor to prevent a recession, but they did have the power to restore liquidity to markets, which central banks did, and to provide companies and individuals with really a bridge to get us to the place where we can be vaccinating against the disease. And governments did this with huge swathes of support, from furlough schemes to checks in the mail. Policymakers really did pull out all the stops. And this certainly is one thing that informed the way that we were responding in portfolios. Now, the vaccine development too has been incredible. I think before this pandemic, the average time to get a vaccine developed was 10 years. And this time around, we've got several effective vaccinations to market in less than a year, which really goes to show the advancement of medical technology, which is something that our global equity colleagues are talking about a lot. Now that brings us to today, where while we're still fighting the virus in many places, we are in the midst of a synchronized global economic recovery enabled by vaccines and fueled by continued support from policymakers around the world. And in that context, markets have continued to find new highs. Now, from an asset allocation standpoint, in the global balanced funds, we spent the first quarter of this year with a preference for equities over fixed income and a neutral stance on cash and property. And I wanted to spend the bulk of our time today thinking about how we're positioned for the future and some of the views and outlook that drive that positioning. But perhaps first to kick off, I could ask you both to think back to a year or so ago and think about how you responded in your respective portfolios to the massive market response to the onset of the pandemic. Alex, do you want to start from an asset allocation standpoint? How did you react to the huge market moves across asset classes?
Yeah, sure, delighted to. First of all, just to say good morning to everyone, and delighted so many of you are listening to us talking about the fund. How did we react? I mean, certainly when coronavirus hit, we did a lot of kicking of the tires, a lot of medium-term analysis, looking at how things might pan out. And I think the things that struck us most were, and Felicity certainly mentioned some of these. I mean, the first thing that really hit us was the phenomenal response from central authorities around the globe, central banks and governments, to sort the problem out. Monetary policy was loosened to a huge extent. Your interest rates were taken down to zero straight away everywhere. Massive quantitative easing programs announced, much bigger than anything in the global financial crisis. And huge fiscal packages. Governments started spending money at a huge rate. And this was such a contrast to, as I said, the global financial crisis, where authorities were slow, hesitant, did a bit of this here and a bit of that there. This time they went in all guns blazing. And we thought that the impact of that would be significant in getting economies through. Secondly, we thought that COVID, while being a big hurdle, don't let me underestimate it at all, a huge hurdle, a huge problem, it was a temporary one. Underneath it all, economies were in reasonable shape, financial systems weren't broken. So once we got over the hurdle, we could get back to normality. And the third thing that struck us was that value had been thrown up, real value in equities. Yields had gone up nicely, PEs were down to well below average levels. There was good value there for the medium term. So add all that up, we thought for the long term, a medium term investor, there was real value in equities. So we sat tight with what we had, and indeed we added to our equity holdings. And that clearly has been a very beneficial move. We've had a fantastic bull market since. And at the same time, bonds had performed very well, as many investors had run for the safety of bonds. So we took some profits there and reinvested that money into equities.
Adrian, Of course, you are the manager of the global bond sub-portfolio of this STANLIB Global Balanced Funds. And in that portfolio, you're investing primarily across developed government bonds and also kind of higher quality corporate credit, which really moved in different directions, with credit spreads jerking wider, but government bonds yields finding new lows. So how were you positioning the global bond sub-portfolio in response to some of these moves?
Yeah, thanks, Felicity, and it's great to be here. So thank you very much for inviting me. Yeah, from a bonds perspective, when I think back to that time, of course, most sort of striking memory, I suppose, is that like most of us, we were instead of sitting in a fully equipped trading floor surrounded by one's colleagues, we were all suddenly sort of cast asunder, sitting at kitchen tables and in spare bedrooms and so on, and trying to run portfolios during a period of immense turmoil, which which is significant, I think, not just because of what it meant for the way that we operate, but because it affected the way that markets operate. And one of the most sort of striking manifestations of that, I suppose, was the disruption we saw in the middle of March in the Treasury market. I mean, normally you would expect the Treasury market to be the absolute bastion of safety. It's where, as Alex said, it's where investors run to when times have become uncertain. And the remarkable aspect about last March was that the Treasury market itself was far from immune from some quite serious disruption. And I think at least part of that was a function of not only portfolio managers but bank trading desks operating in a very weird environment via laptops from their kitchen tables. And so I think that, as well as an awful lot of leverage that is sort of accumulated in the Treasury market, the way that a lot of traders and leverage players have been using the Treasury and futures markets as a sort of arbitrage tool, as well as those factors, this kind of weird working environment kind of contributed to this amplification of the market dysfunction. And so very odd to find that despite having been actually positioned quite well in our global bond portfolios, we've been underweight credit risk because we'd had a slightly less optimistic view of the US economy, particularly as if you remember back to 2019, we were worried. Everyone was very worried about prospects for a sort of trade war between the US and China, and we considered that was still a serious risk to the global economy. Of course, we didn't know quite what the really material risk would be as we went into 2020. But we'd been positioned underweight credit risk, overweight in duration, and so actually the positioning was the right one. But that disruption in the Treasury market, which meant that Treasuries were selling off at the same time as stocks, as corporate bonds, was really took us by surprise. And like Alex alluded to, it was the Fed that really got on top of that by supplying an awful lot of liquidity via repo operations, by buying Treasuries outright, and by changing leverage rules and so on, that managed to alleviate a lot of that stress. And Alex is also right that one of the really one of the kind of opportunities thrown up by that episode in March was that when the dust settled a bit, it turned out that there was an awful lot of value lying about, and that was as true for bond markets as it was for equities. One of the things that we observed during that period was that even extremely high quality bonds that we had been holding almost as sort of Treasury proxies had widened out in their spread to Treasuries quite significantly, way beyond what was justified by any sensible analysis of willingness or ability to pay. And so there were great opportunities at that point to build back into some of our credit risk, which is what we did in some pretty high quality names that have been, in our view, unfairly beaten up.
So you've both spoken a bit about leaning into those areas that have been very badly beaten up, but of course since then, bringing it back to today, we've seen a phenomenal rally in certainly in risk markets. And I think a question that certainly we get asked a lot by our investors is, have risk markets got ahead of themselves? Now, Alex, perhaps from an equity perspective, first of all, do you think things are looking silly here, or are valuations justified at these undoubtedly elevated levels?
I think it's fair to say equities are fairly expensive, but I don't think it's excessive. Certainly valuations are above average, but by definition, markets are going to be above average half of the time. And we're in one of those situations at the moment. I don't think it's got to bubble territory at all. I think it's justified. And I think the important thing is that, to me, equities have got the wind behind them. There's a lot of things going right for equities at the moment. And the first, and we've talked about it quite a bit this morning, is what the authorities are doing. The authorities are going to keep their foot on the pedal, keep their foot on the accelerator. Monetary policy is going to remain loose, and fiscal policy, likewise government expenditure, is very accommodative. We've seen, huge fiscal packages announced in the US. Biden's 1.9 trillion rescue package a few months ago, and then more recently his $2.25 trillion infrastructure package he wants to get through. These are massive deals. So I think policy remains very, very loose, which is good for growth, which is good for equities. Secondly, the economic news is actually coming through. What's happening, I think, is very encouraging at the moment as well. If you look at business surveys, they are up at the highs for a very long time. And consumer information coming through about housing, retail sales, employment, they again are all very encouraging. I think there's a lot of pent-up demand out there, both with companies and with consumers. It feels as though we're getting a V-shaped recovery around the globe. It wasn't long ago people were talking about all sorts of letters for the shape of the recovery, a W, an L, a U, but it really looks like a V-shaped recovery. People are coming back in good shape, spending again. Thirdly, the vaccine news remains very encouraging, both in terms of the speed of the rollout and the number of vaccines we've got. We've all heard a lot about Pfizer, BioNTech, and Oxford University, AstraZeneca, and Moderna's coming on stream, and the Johnson & Johnson one is coming on stream. But there's others as well out there. Glaxo have got one in phase 2 trials. CureVac have got one in phase 3 trials. Valneva have got one in phase 3 trials. There are more vaccines, and the more vaccines we have that are authorized for use, the faster the rollout will take place globally, and therefore the faster we get back to normality. And the final thing that's helping equities, and I think will continue to help equities, is very good corporate news. The last reporting season we had was fourth quarter last year, and just as an example, in the US, 81% of companies reporting for Q4 results were ahead of expectations, ahead of analysts' forecasts. And that's really a very high figure, very encouraging, and that leads to upgrades in forecasts for the future. And it's corporate earnings that drives markets. That's what affects the PE. That's what you're buying. When you buy an equity market, you're buying a share of that earnings pool. So I think there's a lot of good news behind equities. They look a bit expensive, but I think they will continue to perform. I think they've got further to go.
Adrian, what about in your asset class? Certainly in corporate credit, where spreads have tightened meaningfully from the wides of last spring, do valuations look stretched to you?
I'm not sure about stretched, but definitely pretty full. It's quite hard to get very enthusiastic about credit spreads at these sorts of levels where, once you normalize for duration, US corporate credit spreads are now at multi-year tights. There's still, we think, a little bit more value in European credit than there is in in US, but we tend to think that credit spreads are over sort of medium to longer term and fairly mean reverting. And when you put them against their long-term averages, both US and European and global credit spreads are all trading inside their long-term averages by as much as about 3/4 of a standard deviation. So not super stretched. And like Alex said, the thing about averages is that stuff is supposed to sort of trade both sides of them. And so definitely wouldn't rule out further tightening, but it's hard to get super enthusiastic about valuations at this point. I guess I mentioned we still think there's a bit more value in Europe. We think credit curves are still reasonably steep, and we think they can flatten in places as you get sort of duration buyers edging out further along the curve. The technicals still quite supportive. Flows have sort of been flat year to date into the credit asset class. But we'd expect a much tighter supply picture over the course of this year than we had. Yet a huge deluge of supply the second half of last year and the first month or two of this, and we'd expect that to moderate. So the supply side is probably going to tighten conditions up a little bit. Meanwhile, as we both alluded to a couple of times, central banks are still hugely supportive of risk assets generally, and in credit explicitly, because in many places the ECB, for example, still accelerating their purchases in the official QE programs, still committed to providing very accommodative monetary conditions. And so when you kind of add that to a fundamental picture that is reasonably good, earnings outlooks, as Alex said, likely to keep improving as the vaccine rollout continues. We think that most IG firms remain committed to balance sheet deleveraging, although we're sort of pretty alert to the possibility that might change over the course of the year. So with liquidity conditions good, there's no reason to be super negative about credit, I think, as an asset class, although one suspects that the returns will increasingly come from duration. Now we've had this backup in yields and come from duration rather than spread tightening. I think one place where we continue to see a little bit more value is in certain parts of emerging market debt, where especially in the sort of high yielding parts of emerging markets, where spreads have really lagged the tightening that we've seen in US corporates. And I think a story of a globally sort of synchronized recovery, and I think, and there are many caveats to that, but if we are kind of in this kind of global recovery cycle, which is generally decent for commodities and so on, then there may be fairly decent opportunities still in emerging markets.
Now, you've both spoken about the importance of accommodative monetary policy in sustaining risk asset valuations at these levels. Low bond yields have been incredibly important. Adrian, you touched on this. That view has been challenged a little bit in recent weeks as market expectations for inflation have risen, and we have seen a bit of a backup in bond yields. So I'm interested to hear, do you see inflation as a threat? Do you see sustained levels of inflation coming through? Or is this just something that's more temporary as economies open? I don't know who wants to take that.
Yeah, I'm happy to. Probably what I think about most, more than anything else at the moment. And it's definitely true that the degree of uncertainty around the inflation outlook is unusually high. And I think there's a few reasons for that, partly because it's such an unusual economic cycle. All the kind of usual playbook is just out of the window. We've not had this, this is not a crisis that took place because there was a huge amount of leverage and it all suddenly unwound, and now we've got a big deleveraging cycle ahead of us. It's not a cycle that was brought to a halt because interest rates got very high. And so one of the kind of things that we've been thinking about a lot is A, how you get inflation. Do you get inflation? Do you get it on a sustained basis? How do central banks respond to that inflation? Do they respond in the way that we have sort of been trained to expect them to respond over the last couple of decades? And is there, and I suppose most crucially, is there anything about this cycle and this pandemic that changes the kind of the structural inflationary environment? We've been in a kind of 3-decade or 4-decade period where inflation has been on a structural downtrend, and there are books written on why that might be the case, but the globalization, the demographics, the advent of technology and so on have all kind of exerted this downward pressure on prices. So is there anything about the way that economies have developed over the last year that changes that? And so taking those in turn, are we going to get inflation? Yeah, we're going to get inflation. We're already getting inflation. So much of it is baked in already because the base effect is so huge. Last year's declines in prices around this time last year are now starting to kind of flip out in the year-on-year comparison. So we're going to get inflation in the US of somewhere near, it's going to hit 4%, I expect, at some points during this year, or if not, get pretty close to it. As service sectors reopen across the world, you're going to see big year-on-year increases there. We have big energy base effect. Oil prices have come a long way from a year ago. You've got a lot of supply bottlenecks that have emerged due to this sort of huge uplift in relative demand for goods over services over the last few months, as we've all been consuming far more goods, and we're unable to consume services, so we've just been basically ordering goods on Amazon, and so you've got these sort of bottlenecks. The way that we've changed our behaviour over the last year has meant that in the US, for example, prices of used cars are accelerating at a huge rate, or have done over the last half year or so. So a lot of that inflation, we know it's there, and the Fed is sort of telling us that that's something we need to look through. It's transient. That is not what that is. That is a shift in the price level. It is not a permanent. It's not permanent pressure on the price level. What is more unknown is how much demand pressure there will be on prices once economies fully reopen. We know that there's an enormous, to taking the US as an example, we know there's an enormous amount of savings being accumulated in the US over and above what we would expect. When and if those savings sort of get released into the wild, do they deliver a whole bunch of pent-up demand that puts upward pressure on prices? And that depends on a lot of stuff we don't know. Do we know how much of those savings will get spent? Well, we think we do. There are a lot of surveys, but we don't. Surveys suggest that a recent one I read suggested that in the third stimulus check that US consumers have just received, about 60% of people said that they would save that stimulus check rather than spending it. That's an enormous shift in in the normal kind of spending savings relationships that we would expect. Maybe that will change once economies open up, or maybe it won't. If that pent-up demand is directed towards services, are there limits on how much you can spend on haircuts or restaurant meals and so on? Well, there probably are. I kind of intend to push the limits on what you can spend on restaurant meals, but there are kind of a finite number of nights out in the week that you can eat. There's a finite number of haircuts you can pay for, or holidays you can take. And the other sort of question mark, I think, around that excess savings is where those savings have accumulated on the income spectrum. There's quite a lot of work on this that's being done by central banks, and the clearest one, I think, is what the Bank of England found a couple of months ago, which is that pretty much all of these excess savings in the UK, at least, and there's no reason to think that it should be particularly different in the US or in the Eurozone, has accrued to the top 40% of the income scale And that is the part of the income scale that tends to be have a lower propensity to spend their savings. They regard that additional income more as wealth than as income. And so that we'd expect them to be less likely to spend it. So that's not to say that the excess savings don't give you inflation. It's just that we just don't know. And so I think that would sort of keep me a little bit hesitant to expect that we're going to see a really sustained demand pull inflation coming through. Second thing was how central banks respond. The Fed has told us that it's changed its reaction function, that it is prepared to allow inflation overshoots, which it hasn't done in the past, that it will be deliberately slower to normalize policy than it has in the past. That gives us another question mark over whether we're going to see spikes in inflation much higher than we used to. And the final thing that I mentioned, I'm sorry, I'll hurry up. The final thing was about whether the sort of structural trend changes, and I find that hard to believe. And the reason is that none of those big drivers that I spoke about before are really going anywhere. The demographics aren't changing, not in a rapid way in advanced economies anyway. The technology, if anything, is just accelerating, which only serves to sort of drive down the price level rather than up. And so, and globalization may, at the margin, take a hit from COVID-19, but I think that is it's a bit of a stretch to expect that the kind of deglobalization effect to give you to sort of reverse the long-term disinflationary trend. So I would expect inflation to remain relatively benign over the medium to long term, notwithstanding the spikes we're going to get this year.
And you think central banks, because of that, will be able to look through transient rises in prices as economies reopen and therefore keep accommodative policy in place?
I think that would be their intention. I think for many central banks, for the ECB, for example, they don't even think they have that luxury because they are so far away from having a sort of incredible having a credible inflation target that I don't think they would even have the luxury. They just have to keep policy on the floor for a very extended period. For the Fed, I think the market is kind of trying to test them at this stage, trying to steepen up the Eurodollar curve, trying to price in a more aggressive rate hiking path than the Fed is probably comfortable with. In a way, that kind of regulates expectations of inflation, because even without the Fed telling you that it's going to hike in 2 years' time, the fact that the market is starting to price that in is having the effect of flattening out break-even inflation rates at the longer end. So we've actually, although 5 and 10 year break-evens have risen quite markedly over the last 3 or 4 months, they've really plateaued in the last 3 or 4 weeks. And I think part of that is that the market is sort of saying, well, we don't believe you. We don't believe that a central bank can sort of change its spots that easily. We think when you see the whites of inflation's eyes, you'll be hiking.
Sticking with the bond theme for now, but perhaps more from an asset allocation standpoint, Alex, you have been underweight fixed income overall for some time. Can you explain the rationale? Is it just a valuation thing, or is it something more?
It is precisely as you say, a valuation thing. I think the background for bonds is perfectly healthy at the moment. You know, we've talked about very low interest rates. We've talked about ongoing quantitative easing. We just heard Adrian's view on inflation. Medium term, we're going to see inflation rising now. That is all good news for bonds. The problem is valuations. Yields are just very low. We don't see them shooting up much in the short term. But having said that, we just see much better value by investing in equities, and we've clearly talked about that. And we see better value in property, and I'm very happy later on to talk about that. So bonds just seem the least attractive from a valuation point of view for us, hence the underweight position.
Although it is important to note, of course, that we are, with the global balanced portfolios, investing not passively. If Alex is allocating to an asset class, he is allocating very much to an actively managed portfolio. And Adrian has shared, that he is finding some opportunities in European credit, in EM, for example, and we may well have time to come back to that. But I just wanted to first move along to equities, because another question that we have been getting quite a bit, and that Alan mentioned in his introduction, is around the relative performance of different equity styles. Because we have seen a long period of quality companies outperforming their more cyclically exposed or value counterparts. And this was very, very apparent last year too. And Alex, of course, this was very helpful for the sorts of companies that you're exposed to in this portfolio. But as economies have reopened and bond yields have climbed a little bit, value stocks have certainly caught up, at least a bit. Alex, is this a worry? Do you think the value rally has further to run, or are you sort of sticking with quality growth?
As you say, we have had a preference for quality growth, and that did us extremely well last year. We have more recently seen this rally in cyclical value type stocks. And I think that may go on a bit further, particularly if we get more good news on vaccines, and I've hinted that's quite likely, and if we get more good news on growth, and I think that's very likely. I think the risk to global growth is on the upside. But I think we've already had quite a big bounce in value and cyclicality, and certainly for the medium to long term, we still favour good quality growth companies. And there's two reasons really for that. One is that it is still a tough world. So you do need to pick companies that you believe in, that have got strong management, that are in the right place for tomorrow's technology, good balance sheets, etc. And secondly, and I think very importantly at this time, is that there were a number of trends very much in place before COVID in consumer behavior, business behavior, etc. That COVID has just accentuated and accelerated. And I'm talking about things like online everything, cashless payments, streaming, cloud computing, virtual meetings, etc. And as a result, I think it's crucial to back companies that are benefiting from these sorts of moves. And that is basically the growth companies. I mean, shorter term, we did add a little bit of cyclicality sort of towards the end of last year, things like building materials companies in Europe, railroad companies in the US, etc., just to reduce the damage that might happen in a cyclical rally, and we've done that. But deep down, we still think for the medium to longer term, stick with those favoured companies that you really believe in, that are in the right place for the way things are going. And if I tell you the 5 largest holdings in the equity sleeve of the balanced funds, Alphabet, Microsoft, Amazon, Samsung, and MasterCard, I think you can see a quality growth bias definitely in the portfolio still.
We haven't yet spoken about property. You mentioned it, Alex. Of course, global property is part of the global balanced portfolios, a portfolio that again is actively managed by the property team at STANLIB. Alex, it's an area that from an asset allocation standpoint, you're neutral on. Can you just share some thoughts around what drives that neutrality?
Yeah, sure. Property at the moment, it's a difficult one, without doubt, and there's positives and negatives. And if we look at the positives, I mean, first of all, we've talked about it a lot, monetary policy, very loose, low financing costs, and that clearly makes property cheap to purchase, which is clearly beneficial. There's certainly value in property. Yields are good, and everyone's looking for yield from their investments. And I think importantly, you stress that this portfolio is actively managed in all regions, whether it's equity, bonds, or property. And I think that is really important in the way we look at property, because Keelan and his team have identified some really interesting niches, which I think can show decent growth. Things like tower companies, the people that own the masts for Wi-Fi, for internet access, etc. They are doing very well. Data centers for cloud computing, that's a great area, massive growth in cloud computing. Life sciences buildings, technology buildings in towns, logistics companies. They're the sort of the mechanism for all the online buying we're doing, the storage, the distribution. Companies in that area are doing well. Self-storage in America is a very interesting niche. There's a real move, the younger generation don't want to carry on living in the suburbs like their parents. They want to be closer to work. They don't want to commute. They want to be closer to restaurants, closer to each other. They're moving back to city centers. As a result, they need storage for their furniture because they can't quite get around to selling it. So self-storage in the US is an interesting growth area. So there's a lot of active investment in growth areas. So that's positive. But on the negative side, clearly you've got retail, bricks and mortar retail in high streets and malls is struggling badly. We've seen that for some time. And the big new question is offices. What's going to happen to offices? How much time we're going to spend in them? Do we need much less space or roughly the same or a bit less? And the jury's really out on that. And companies are doing very different things. People like Goldman Sachs are encouraging workers back. Google is encouraging its workers back. But at the same time, people like HSBC, Barclays Bank are just cutting their office space. And recently, Aviva, a big insurance company here in Europe, said they were cutting their office space by the end of this year by 30%. That's a lot, and that is 7 football pitches worth of office space. So the question mark is very much there on office property. So you've got the positives, you've got the negatives, and as you said, as a result, currently we're neutral on property from an asset allocation point of view in the balanced portfolio.
Super. Now, I want to make sure that we still have time to take any questions from the audience. So perhaps just one last kind of broadish question to finish off. We've spoken quite a bit about the economic recovery that we're in, but Adrian, you mentioned that there are some quite major caveats around the phrase I used, which was a synchronized global economic recovery. Now, where are you seeing kind of particular strength, and where do you think the recovery is looking more fragile?
I'll be super quick because I'm conscious that we do need to leave a bit of time. It's a massive question. Yeah. But in short, this recovery started in North Asia. That was the region that went into sort of slowdown first and emerged first. That was very much the story of the second half of last year. I think the story of the first half of this year, or should we say the middle half of this year, the second and third quarters and probably beyond, is a story of US growth exceptionalism. That is a function of the development of vaccines and the rollout of vaccines, which is going to be mightily impressive in the US, as it is in the UK and various other parts of the world. But the US is really going to be kind of first out as far as vaccination goes. The size of the fiscal stimulus that has just been, in addition to all the stimulus packages that were delivered during the Trump administration, the latest Biden package is quite phenomenal in its size, and that will undoubtedly juice the US recovery in a way that the rest of the world will struggle to keep up with. And so when you're sending $400 billion of direct payments to consumers, that's going to make a big difference. We talked about base effects and inflation. There'll be big base effects in growth as well this year, and the US comes out pretty close to the top of the pile. We expect 6.5% growth, near enough, this year out of the US. So And then you've got the prospect of an infrastructure plan as well. Now that might be a slightly longer burn, but definitely kind of stacks things in the US's favor. So we would quite strongly believe in a US-led global recovery. One of the things that concerns us most is the other side of that coin. Not so much Europe. I think Europe will kind of get there on vaccines. It's been a slow start. It has far more sort of structural growth headwinds that will, we think means it will kind of lag over the medium to long term. But the distribution of vaccines globally is something that is a concern to us, and I think that is one of the risks really, is that you have this kind of very uneven recovery as developing nations sort of lag in the vaccine rollout. Supply chains may remain fairly disrupted as that sort of plays through. So that's I think kind of the risk is that once the kind of initial sort of sugar hit of the global goods recovery kind of matures a little bit, that there is the emerging markets have sort of less going for them relative to the US. That keeps us, by the way, slightly more positive on the US dollar for the time being. I said I would be quick. I lied. Sorry.
Well, I'm aware there are quite a few questions coming in. We've covered quite a few big topics, and so I'm sure there are going to be follow-up questions. So with that, I will pass back over to Alan.
Thanks, Felicity. Alex and Adrian, appreciate it. Apologies, I have changed rooms. We are having serious Wi-Fi issues downstairs, so I've just changed venue just to make sure that I don't lose signal. But thanks very much. I've got quite a few questions. Mike Jankelowitz, I think your question that you posed with regards to the risks to kind of sustainable recovery pretty much been answered by Felicity's last question to Adrian. So I think we've addressed that amply there. The first question I'd like to pose, and I don't know, between Alex and Adrian, you can decide, maybe it's more for Alex, but a question from Craig Gradich is, are we seeing the start of a commodity, your views around, do you think we've seen the start of the commodity super cycle? And if so, what is your view in terms of emerging markets, potentially being overweight emerging markets relative to developed markets?
So I don't know, do you want to go first, Alex?
Carry on, if you want. No, carry on.
So yeah, I think it's a really good question, and I don't think I'm quite at the answer yet, but I definitely think that's kind of where we've come from. So I think there is probably still some sort of residual advantage for emerging markets, given that the first stage of this recovery has been a fairly commodity heavy one. It originated in China. We know China is a huge source of demand for commodities. We know that the global goods trade has been extremely buoyant. We've been pretty keen investors in port facilities, for example, in emerging markets for exactly that reason. Trying to sort of exploit that trend. Are we on the cusp of another super cycle? I think that is a tougher question, partly because unlike previous recoveries, unlike the recovery we just had, and unlike the recovery after the financial crisis, I don't think we can rely on China to drive that recovery with a huge amount of investment. In some ways, China is still kind of paying the price for the overinvestment conducted in the last decade, and even before that. And so I think the Chinese authorities are going to be much more alert to the risk of overheating and the risk of building overcapacity. And so I think that is a kind of a caveat to the positive commodities view over the medium term. I also am aware that the recovery when it happens in the US and elsewhere is likely to be a service sector driven one. That is definitionally a less commodities intense part of the market. So I think we're in a kind of, I think we are in fairly late in the commodity cycle, we put it that way. And I think that for the time being, I think that remains a support for emerging markets. It's one that I'm very wary about riding for too long.
I would just say on commodities, I mean, being optimistic on growth, I do see demand for commodities without any doubt. And I think in today's environmental world, it's more expensive to get out, which will push up commodity prices. But just there's lots of different areas of commodities, and base metals, I think probably the environment is pretty healthy and there's lots of demand for those from lots of places. But some big areas of commodities, I think, doesn't look so good, and energy tends to be the usual place. Oil tends to be one of the biggest areas, and I think the sort of medium-term trend for oil is just less and less demand for it. Everyone's going more green. And so I don't see, and there's bags of this stuff around still. I don't see a great increase in the oil price over the medium term. And gold's the other area where, again, I struggle to get very enthusiastic. We've talked about limited inflation risk, and inflation obviously often pushes up the gold price. Feeling fairly optimistic about growth. Again, people rush to gold in difficult times, and I think now we're, having been through a very difficult time, we're coming upon a sort of easier time. So I think there's areas within commodities that don't look as good, although there are some that look encouraging.
Okay, perfect. Thanks, Alex. Thanks, Adrian. Alex, a question for you, and often we get this question from clients, and I mean, it's been posed again. I know that you have answered it before, but maybe for the broader audience. Obviously, the STANLIB Global Balanced Fund has kind of a limit of 60% on equity relative to an SA Balanced Fund, which has 75% from a kind of asset allocation perspective. I mean, if I had to pose a question, what is the max, if that's your limitation, what is the max that you would go in terms of equities in the Global Balanced Fund? If you could, what would your view be?
As you say, the benchmark is 60%. The neutral position is 60% in equities. We certainly would be comfortable going up to 70%. If we really felt optimistic, we'd go a bit through that, but probably not a huge amount further than that. I mean, balanced funds, you do want to keep a balance. And I think that's what investors do look for to some extent. The whole point of a diversified fund is that if one area comes under pressure, you've got the other asset classes that you hope will be a counterbalance. And I mentioned earlier on when in the bear market with COVID, that equities obviously plummeted, but bonds did much better. And that was a nice counterbalance in the portfolio. So I think to push everything too hard it is not necessarily a good thing. And I think taking it up to 70 or perhaps a fraction through is still making a big statement. And that's a big percentage in equities. And of course, the other thing you need to remember is that if we're optimistic on equities, we're well above our neutral position, we will probably be in quite high beta type stocks, the sort of companies that are really going to benefit from that performance in equities, not the sort of defensive, dull utility type companies that probably will lag. So there's a bit of extra juice in there as well as the percentage in equities. And similarly, Adrian has said, at a time like that, if we're optimistic about equities, optimistic about companies, we'll probably have more credit in the bond portfolio. So again, there's more leverage into the expanding position than just that bald figure in equities.
Okay, perfect. Thanks, Alex. Adrian, this question is for you, and there's a few questions that have come through, I think, as part of your title, the head of currency. So just a view on, if you could, on the Rand relative to other major global currencies, if possible. We've got one or two questions that have come through with regards to that.
Yeah. So I mentioned so briefly that we've got a long US dollar bias, and and that's largely a function of this sort of growth bifurcation, if you like, the US leading. We expect that to come through in rate differentials as well, but primarily we think about that dollar view against major global currencies, the euro being the most important. And that difference between the Fed's reaction function, or rather what the market wants the Fed reaction function to be, and the ECB's is extremely stark. And so while the Fed is kind of content to allow financial conditions to tighten at the margin, because that's a good way to kind of stay on top of inflation expectations, which is kind of half or more of the battle in maintaining control over inflation. The ECB just doesn't have that luxury. It needs to keep financial conditions as loose as it can, especially with the euro having appreciated on a trade weighted basis. Now, against emerging market currencies, it's a slightly different calculation, but I think we sort of come out in roughly the same place, which is that we still favour the dollar. Like I said, we believe that we are in the sort of final part of or that most of the kind of low-hanging fruit in commodities has already been picked. Let's put it that way. So acknowledging that it remains a support for emerging market currencies, it is going to be difficult for them to appreciate meaningfully in a positive dollar environment. It's very unusual for emerging market currencies to appreciate while the dollar does against the euro. And so for that reason, we remain a little bit cautious around EMFX, not least because one of the kind of key risks is that the sort of theme of liquidity withdrawal as the US recovers, as this recovery kind of takes hold in the US particularly, but in developed markets more broadly, that the sort of dominant market theme will be one of liquidity withdrawal. That's one in which EMFX is going to struggle as well. So in that context, the Rand, while we've been, I've got to say, our analysis, our perception of the fundamentals has been improving, if anything, over the last few months. The terms of trade have improved on the back of commodities. The external position has improved. That should be a support for the currency. I think on the margin, the fiscal news has improved against what were pretty I've got to say, pretty grim expectations at times last year. So all of those things are supports, but the Rand has already done an awful lot of work versus some of its peers, and so valuations at these levels we find much less compelling. So we're kind of underweight EMFX generally, and kind of neutral on the Rand, and that leaves us being on net being a bit less positive on the Rand against the dollar.
So I won't pin you for a rate at the end of December. What do you think the Rand would be relative to the dollar?
Thank you.
I'll let you have the hook on that one. Thanks, Adrian. Ladies and gentlemen, we up for time, so it is 12 o'clock. There are one or two questions we haven't got to, so we will engage with the Columbia Threadneedle team, some specific questions around cryptocurrency, a view on the UK, etc. But I think in the kind of elements of time, we committed to finish by midday, but Arnold and others who've asked those questions, we as a team will get back to you with answers. Our next webinar, ladies and gentlemen, is next week, Tuesday, I think, let me just double, Tuesday or Wednesday at 9:30. The save the date has gone out, so you would have got it. It will be hosted by Kevin Lings, looking at the state of the South African economy, and then looking to see how growth opportunities could potentially unfold in the SA economy. He'll be joined by Victor Mapuli, head of our fixed income business, and Johan Mardovic, who heads up our credit alternatives business. So hopefully you can join us next week. And once again, on behalf of the STANLIB team, Alex, Felicity, and Adrian, thanks very much for joining us. We hope you've enjoyed the session, and we'll see you soon. Stay safe out there. Thanks very much again for joining. Cheers.
Thank you so much.
Thank you.
Thanks a lot.